You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello, welcome to The Investor Way with me, Sam Ball. It's the 14th of October 2023, and I'm joined by my co-host John McEwen. In this week's episode, we'll be discussing Tesco, Greggs, Imperial Brands, D Wetherspoon, Boohoo, and our US company of the week is Nike. John, do you want to start us off with a favourite of the show, Tesco?
Yes. So Tesco, Britain's largest supermarket, had their half-year results out last week, with group sales rising 8.4% to £30.7 billion, ignoring the effect of exchange rates. And this included retail like-for-like growth of 7.8%. And the group's biggest market, which is the UK, saw like-for-like growth of 8.7%, with sales of £21.8 billion. And Tesco's has continued to invest in keeping prices low, with inflation falling for the period. Tesco Finest ranges have seen positive momentum, with UK volumes of the range rising 4.1%. And overall trading has been better than expected. Underlying retail operating profit rose 13.5% to £1.4 billion, and the better than expected performance means that Tesco's now has slightly upgraded full-year expectations, with underlying retail profit now expected to be between £2.6 and £2.7 billion. There was a 6.6% increase in retail free cash flow to £1.4 billion, and net debt fell from £10 billion to £9.9 billion. An interim dividend of 3.85 pence per share was announced, which was in line with last year, and the shares were up about 2.7% in early trading. In terms of valuation, Tesco's has a market cap of just under £20 billion and trades at 11 times forward earnings, with a dividend yield of 4.5%. I thought these were really good results in a difficult trading environment, and as the group mentioned, they've invested a lot in keeping prices low. That was something post-2008 that they probably got wrong. They tried to maintain really quite chunky margins, and you saw a lot of people moving to some of the challenger supermarkets or discounters like Aldi and Lidl, which that's not happening now, or to a much lesser degree anyway. So they're attracting both those customers that are looking for value, and then also those who are trading down from more premium supermarkets like Waitrose. So they've got sort of a quality value proposition. They've also got the economies of scale, and they've got Booker as well, which is now really feeding into the earnings after a difficult COVID. It is a company that I do like. I have previously held it. I actually recently sold it as I was sort of simplifying my portfolio, but that was not for any concerns with the business. I think it's very healthy. Where it goes in terms of growth, I suppose that's difficult to know because it's pretty saturated in the UK. It's got the largest, it's the largest of the supermarkets. It's difficult to see how it can grow market share much more. However, as you see, it's generating decent profits, and it's got a very healthy dividend now, which is well covered, which in the sort of recovery years after, 2008 and then particularly 2014, the accounting scandal, it had really struggled with, but really healthy business, best of the supermarkets in my opinion. And I think if you were getting it more as a dividend play, you couldn't go too far wrong, I don't think. Sam, what are your thoughts on Tesco's?
Pretty similar. Since we entered the cost of living crisis a year or two ago, I think the results, I wouldn't say disappointing, but the results were slightly lagging inflation. But that's because, as you described, they'd made that decision not to increase prices with inflation, so they didn't lose the market share to the Aldis and Lidls. And we were saying throughout, I do think this is the correct strategy. I think this is the first set of results since then where that's sort of demonstrated that it is the case, because I think the 8.4% revenue increase, that's pretty good. But then the operating profit increase of 13%, I didn't expect them to be putting up figures like that. I think they've done really well on the cost side. Whether it's because they've just, absolutely shafted some dairy farmers or something, I don't know. But really, really good cost control. these are a better set of results. The revenue's about where I would have expected it to be, but I just didn't expect the operating profit to be that good. I didn't actually realise, I knew they were mainly UK. I didn't realise that UK revenue was only like 70% of the total. Do you know what's left that's not UK?
So it's got, I think, Republic of Ireland. So
Right.
I guess, yeah, Republic of Ireland. And then I believe they still have some of the Central European business. But obviously Thailand was sold off. So there is a little, well, I say a little bit, it is fairly significant, amount that does come from outside the UK. But obviously UK is its core market.
But yeah, I thought these were a really, really good set of results. And probably, although I've agreed with the strategy in the past couple of years, it did have an impact on the results. But I think this is probably the best set of results they've put out in probably the last 2 years, I think.
Yeah.
So how did you do overall when you sold?
Oh, okay. So I'm just thinking now. So I think I must have bought the shares at £3.50, maybe. Something around that. And that was back in 2013. So I held Tesco's for 10 years. Initially, they were paying a reasonable dividend. They had the horse meat and the accounting scandal, and then I think it was cut all together for a time.
Did you buy before both of those scandals?
Yeah. Well, no, I bought after the horse meat scandal. And I think around this time, Buffett had shares in Tesco's. He didn't have them for very long, but he did have them. And then the accounting scandal happened. And that was when things were really knocked down. And the business was nowhere near as healthy as you thought it was. And then there was the various sort of turnaround strategy, and they have become so bloated. And they're sort of, well, a couple of strategies ago, it was becoming these huge hypermarkets, expanding overseas, having gyms in Tesco's, buying restaurants, buying coffee chains, all of this sort of random bloat, which was just losing money. And people also weren't doing those big sort of hypermarket type shops that perhaps they were doing in the early 2000s, and perhaps in some countries they were doing. There was a big move towards Tesco's Express, Sainsbury's Local, that kind of thing. Whilst when that was going on, Tesco's was expanding massively in the big supermarkets. So it was completely the wrong strategy. And at the same time, they were trying to maintain these fat margins, which were then, cut down to kind of what they are now, sort of 2-3%. And they were losing market share. And Aldi and Lidl grew massively over that time. And then I think it's only, sort of Dave Lewis coming in and really getting control of costs, strategy, selling off the international business, because they did try to go into the US, which failed. Mixed, I think, in the Far East, and then Central Europe kind of okay. But all of that money that was going in during the good times, and then when they ended, really, I think the business wasn't in a good state. But the turnaround, as we're seeing it now, is really bearing fruit. It's a much better business. Share price wise, though, you're still not where you were back in even sort of 2013. How I did on it, though, I got a loss in the way of dividends over the years, and you
got a fat one from Thailand as well.
I got a fat one from Thailand. So I think it was probably around break even. I mean, maybe losing 5 to 10% if anything, but it's difficult. I mean, I think if you just looked at the share price, it would have been a loss, but if you bake the dividends in, maybe it would have been either a small loss or sort of a break even, I think.
What was the worst you were down?
Oh, about 50%.
Oh, okay, so did it okay then. Like, it could have been a lot worse.
Well, yeah.
Was that down 50%, and that's before you've had the big Thailand dividend?
Yeah,
so
yeah.
That was like
25%,
wasn't it?
Yeah. So I'd been down about 50% for a fair number. It felt like a fair number of years, sort of like 2015, 2016, that kind of time. I haven't looked at the chart recently, but it would have been something like that, which was, a lesson. And at the time, the portfolio, I guess, then was fairly stodgy. So there weren't the type of stock, there weren't any tech stocks in there. And you didn't see such volatility. So Tesco's was that company that was like, bloody hell, that's down a lot in my portfolio, and that's what a paper loss feels like, and it doesn't feel good. Shouldn't look at the charts, but I suppose the fundamentals weren't good either. So it was some lessons learned from holding Tesco's.
Should we move on to Greggs then?
Yes. So how is Greggs doing now?
Greggs have come out with a third quarter trading statement, and it's more it's pretty in line with what we've previously seen the last couple of times we've done the results. So they've said that third quarter sales have risen 20.8% or 14.2% when looking at like-for-like growth from company managed shops. Growth was driven more by customer visits, higher evening trading. Oh, of course, because they've started opening the stores later now, haven't they? Increased use of digital channels and growing market share. 82 new shops have been opened to date on a net basis, and they expect 135 to 145 new shops by year end. Capital expenditure over the year remains on track to be around 200 million. Uber Eats will become a delivery partner alongside the existing operation with Just Eat. Full year guidance remains intact, with markets looking for pre-tax profit growth of 11% to 164.7 million. It's worth noting that although the growth is impressive, it has slowed from the first half, and guidance around new shop openings was a fraction lower than expected. However, they are still targeting 3,000 stores over the next few years. They're currently at about 2,400, but if they're opening at a rate of 130, say 140 a year, they will soon get there. And they plan to increase the number of shops that are franchises from 17 to 20%. They've had 9% cost inflation over 2023. However, they have secured forward cover for food, packaging, and energy costs up to the fourth quarter. And they do expect a cooling effect on like-for-like sales from here because they don't have as much of a tailwind from price hikes like they did last year. In terms of the valuation, the business trades at a forward PE of 19, and that compares to a 10-year average of 22.5. The prospective dividend yield is 2.7%. I think this is a very good trading statement. Slightly below what was expected, but still very good set of results. You've got the Uber Eats revenue coming in. They're still opening new stores at a very good rate. I think a couple of years ago when they were at more like 2,000 stores, we covered it on the show. I was pretty critical of the target. I thought it was too ambitious. I thought it was just going to get too saturated. I know you've always put it slightly differently, John, because you've said, well, down in Oxford, you don't see anywhere near as many Greggs as I do up in the northeast. But
yeah,
you do. You see them everywhere. It's like in Newcastle, we've had a 24-hour Greggs open for years. I think it's the only one in the country though. So I possibly, anecdotally, I'm getting slightly skewed evidence of how saturated they are. I think the target's pretty reasonable. The only issue I would have, it's easy to look at it and say the forward price to earnings is slightly below the 10-year average. But although it looks like they are going to hit that 3,000 store goal, they're getting closer and closer to it. So at some point, the price has to level out unless they're going to all of a sudden come out and say, well, we're going international. We're going to go for 4,000 stores. And they haven't really said what that next step is. So I think beyond the medium term, I'm not sure where the growth is, and they might have ideas, but it's like for the Just Eat and the Uber Eats delivery, opening stores later, there's only so many times you can pull. There's only so many of those levers you can pull before it's, well, hang on, in the UK, you're open all hours, everyone's delivering for you. You either will need to start or buy some different franchises besides Greggs or go international. They are getting to a point where those are the two options, and I don't know if it's the kind of business that would carry internationally or not, but really, really good set of results. But I would just be a little bit cautious on the valuation, because I think in the short to medium term, I'm pretty sure they'll get to their 3,000 stores, but I'm not sure where they then go next. John, what are your thoughts on the trading statement and the valuation?
I mean, I think the trading statement, like you say, is very positive. I don't think there's that much more you can ask for when it comes to delivering on the sort of revenue growth, opening the new shops. Great that they're doing Uber Eats as well as Just Eat, and they're certainly not doing the delivery themselves. You could leave that to Uber Eats. I know what you mean about the saturation, and we're not at saturation point yet, that if you continue with the store openings, the 3,000s, even in the south, you will be hitting that. And then where do you go? And you've got a forward price to earnings of 19, so it's not cheap. And like you say, I don't know how well Greggs would carry internationally. It feels very British, but it's a fairly basic, I suppose, value proposition. I can't imagine it going down well in, like, say, France, for example. That being said, they do continue to deliver. So,
pardon the pun.
Pardon the pun. So where they may, management may have some very good ideas, which they they can continue to grow the business beyond these 3,000 stores. So I certainly wouldn't bet against them. But for me at the moment, I'd be sitting on the fence a little bit with it. I think it's a very good business, though. Don't get me wrong there.
I think maybe it would have been different if sort of 2 or 3 years ago when we were covering it in the pandemic, it'd been cut in half and they were still targeting the 3,000 stores. And we were looking at it and saying, well, a lot of the stores are on the high street. The high street's dead and never coming back.
Yeah.
I think if you'd had the vision to say then, well, actually they're at 2,000 and they're at a lower valuation because of the pandemic, I think they'll bounce back and hit the 3,000 anyway. I think that really was, I know a lot of businesses, the time to buy was in the pandemic, but even if you go back a year or two further, it's kind of like if you'd got them at 1,500 stores or 1,800, but now if you're buying them at 2,400 stores with another 130 on the way,
yeah,
and you're looking at this 3,000, you do need to start asking yourself what's next. Whereas, at 1,500, you didn't really need to do that. I think that's the issue.
Yeah, no, I agree with you there.
Should we move on to another business that's trying to figure out what's next?
Oh, yeah. So Imperial Brands, we've covered it quite a few times on the show before. It's the UK's second largest tobacco company, world's fifth largest. They had a trading update out last week, confirming that they're on track to meet the full year guidance. And ignoring the effect of exchange rate movements, net revenue is expected to grow in the low single digits. Underlying operating profits expected to have grown at the lower end of the mid-single digit range. And the group highlighted that there's been growth across the combustibles and the next generation products. That's been driven by strong pricing and market share gains in its main markets, despite its declines in the UK and Germany. They have announced a buyback of £1.1 billion for the new financial year, which is an increase of 10%. And it also expects a total shareholder payout, including dividends, to exceed £2.4 billion. And that's on a market cap of £11.5 billion. So it's very chunky. In terms of its valuation, it's obviously got the market cap of £11.5 billion. It trades at 5 times forward earnings with a prospective dividend of nearly 10%. There are certainly a few things to say about Imperial Brands and the politics here in the UK. Interestingly, they had the Conservative Party conference recently, and this came around the same time that this trading statement came out. And it was particularly relevant to Imperial because it's got the largest, I suppose, exposure to the UK, which I think is about 11% of Imperial's revenue. And it was that the British Prime Minister, Rishi Sunak, announced that he wanted to introduce a staged smoking ban, so essentially hitting tobacco sales. So I think if you're 14 today, that you would never be allowed to buy cigarettes, regardless of how old you got. So say in 20 years' time, when you're 34, you wouldn't be allowed to buy any cigarettes. But someone who's, say, 15 now, and they're 35 in 20 years' time, they would still be allowed to buy cigarettes. So it's sort of essentially trying to a staged ban, which I think New Zealand have adopted that policy. So it's sort of modelled on that. There was also quite a lot of talk around further regulation of e-cigarettes in the UK, with sort of talks of plain packaging. So at the moment, if you go into a corner shop, you see lots of different colours, lots of different flavors, all available. They're all, supposedly very bright and appealing to children. So there's the proposals to change that and maybe go down that kind of plain packaging route that we went down with regular cigarettes. So here in the UK, they're sort of all cigarette packets are now brown and murky, and they've got health warnings all over them, and probably some hideous picture of cancer on it. So a similar sort of thing to discourage young people from taking up e-cigarettes. So it's interesting to speculate what this would do to Imperial Brands. And as you would expect, Imperial has come out against these proposals. And I know a lot of the Conservative Party politicians have come out against it. I don't think it's certainly not widely approved of in the party. But the opposition party, the Labour Party, have said that they would support this ban or in a similar style. So it looks like at some point it will go ahead, whether it's with Conservative Party votes or Labour Party votes. So that is, a long-term concern from Imperial, given that 11% of their revenue does come from the UK. Perhaps you would say that it's cigarette sales and revenue in the UK are declining. So you probably be reaching that sort of conclusion anyway. And with fewer sales coming from younger people anyway, how much difference is it going to make to Imperial? Who knows? There are also lots of legal challenges that may come forward. Some people have talked about the Equality Act, and there are 6 protected personal characteristics in that. So essentially you can't be discriminated against on the basis of those personal characteristics. And one of them is age discrimination. So an argument that might be made against this, these proposals is that if you're a sort of consenting adult, as it were, and you're 25 in how many years' time, why should you not be allowed to make that lifestyle choice to buy cigarettes? That argument is also being made. Coming back to the plain packaging of the e-cigarettes, I think that's interesting to speculate about, because you wonder all of those sort of smaller brands, which unlisted companies, lots of the different flavors that are available, they often seem to have the brightest packaging. The bigger brands that are owned by the big tobacco companies, and I guess if you want to put Supreme in that category too, they're generally a bit plainer. So I would wonder whether you'd actually see the bigger tobacco companies who own the biggest vape brands. In the case of Imperial, it's Blue, whether they might actually benefit from that and it have impact on those much smaller unlisted companies. I would wonder about that. Other things to mention about Imperial: net debt, it's sitting towards the upper end of the group's target. It's about between 2 and 2.5 times earnings. It's expected to be closer to 2 times by the year end. So it does give the group some financial headroom, and it's obviously prioritizing shareholder payouts. It's got a prospective dividend of nearly 10%, and obviously it's buying back its own shares at a pretty significant rate. The dividend is covered by free cash flow about 2.5 times, so pretty well covered. I think if someone were looking at Imperial, it would be very much on a value basis, and probably just looking at the amount of cash that they're going to be returning to someone as a shareholder over the next however many years, and that it's a business that is in structural decline. It's certainly not something I think that a person would buy on the basis that they think that there's going to be a huge future in e-cigarettes, and it's certainly not priced as that. 5 times forward earnings. But if it stays going, and if someone were buying shares today, they got that money back purely in dividends, and then there was happened to be a future in e-cigarettes, then they still have sort of a viable business on their hands. Because I think whilst there has been impressive, debatable whether you call it impressive, but significant revenue growth from the next generation products, the e-cigarettes, heat not burn, it's still yet to add to the bottom line. So I think it's a difficult one. And I think most people, and certainly institutional investors, are not investing on the basis that it's not ESG, so seeing it as unethical, and that probably really depressing the share price. People would be buying it purely, I think, as a value play, and that there might be future in the e-cigarette market long term. But at the moment, you're seeing, all of the profits are coming from the traditional business that is in structural decline. we've talked about it and compared it a lot with British American in the past. That is more geographically diversified, and their e-cigarette seems to be doing a lot better than Imperial Brands. And we see the depth with Imperial Brands. That was most of that is from buying Blue from Reynolds back, I think, in about 2014, which they borrowed an awful lot for. They paid an awful lot for, and it's really been quite disappointing for them and been more of a burden. So very mixed picture, and it really depends on, what you're buying it for, because you're certainly not buying it for growth.
Yeah, I don't think there's a huge amount to say on the statement, because it's pretty similar to every other quarterly statement they have ever put out, probably for the last 20 years. I think, obviously, Rishi Sunak's proposals in the UK are probably more interesting. I think we do have to be careful with it, because we are not a political show. Not that it probably matters anyway if Labour are saying they support it.
Well,
that's
the
doesn't
point.
matter which end of the spectrum you're on, you're going to end up voting for it whether you like it or not.
That was the point, really. It's not from a political point of view, but if it looks like it's going to happen because both parties, or the leader of one party and then the opposition party, support it, it's probably going to happen.
My view, and do you take this with if you want to fast forward 2 minutes, because we're not a political show, that's absolutely fine. My view is, like what you were saying with the Equality Act, it's kind of like, if you get to a point where you've got a 30-year-old that can legally buy a product and a 29-year-old that can't buy the exact same product, that is just inherently unfair. You either need a total ban or all adults can buy it. I think anything in between is just inherently unfair. And my view is probably a bit more that, if you get to 18 and you start smoking and you're not aware of the health consequences, I don't know how you would get to that stage. Like, there is no advertising. They've got horrible pictures all over them. You're taught in schools. You've got PSHE lessons. Everyone knows what they're signing up for. I would be against it, but I wouldn't have anyone to vote for if that were the case. I'd just have to. Not that, the fact that I would still be able to carry on going out. I don't smoke anyway, but the fact I could go out and buy a pack of cigs anyway, still, that doesn't really change it for me. I just think it's unfair if I can buy it and another adult can't. And then in terms of the plain packaging, I agree in principle. The only issue I've got with that is I just think, because electronic cigarettes are so early still, and they're still taking significant market share from traditional smokers, do you sort of accept the advertising as a necessary evil? But you kind of, like, if you see a smoker that walks into Morrison's or something, you kind of want the e-cigs to be front and central, because you're getting switched. And then once you've got to the point where they're then the dominant where the way most people are smoking, and most people have moved on, they've got the majority of the market share, I think then you hit them with all the advertising bans and stuff. I think if you do it too early, in the same way that it will stop the smaller firms competing with the bigger ones because they can't advertise, it also stops the e-cigarettes competing with the traditional tobacco. I think you need to be able to display it. And I think there is obviously a balance, but I think a total, if e-cigarettes, the packaging was exactly the same as normal cigarettes, I think there would be a consequence that less smokers are switching over. I think I think they need to be very, very careful with that. In terms of Supreme, which I know we're not talking about today, they have said that their two most popular flavors for e-cigarettes are tobacco and menthol. And the reason is because that's what ex-smokers want. Whereas with some of the other brands that you say, are just sort of throwing all the colors and flavors out there, I suspect that's not the case. But yeah, it's interesting. I don't particularly, it's an all right trading statement, this, but I would just rather own, well, firstly, I'd rather own Supreme, but I would rather own British American Tobacco of the pure tobacco plays, just because I think their next generation product is performing so much better. And they're both so cheap that the valuation's pretty, like, it doesn't really change it. It's like if you're talking about buying one at 6 versus 7 times earnings, I'd rather have the better business when you're talking about buying them that cheap. I think if we did start to get a phased ban like we were talking about, I know we're only a small part of the overall market in the UK, but if we got a phased ban and say that was brought in by most countries, I still think, in 7 years' time, you're going to get your money back. It's so cheap and the dividend's so high that even with the phase ban, I think you could still do very, very well off the stock.
Do you think, on the topic of plain packaging with the e-cigarettes, do you think it would likely benefit the bigger tobacco companies compared, or just overall benefit the bigger tobacco companies?
I don't know. I think it could, because you go into you go into different places in the country and like the brands are completely different in some of them. And you will go into one, like you might see it in a petrol station, and it's like a brand you've never heard of. I don't understand. I know they want to distance themselves from the smoking, but I don't really understand why they haven't come out with e-cigarette brands of the same name. Because it's like, if Blue, I know we're talking about two different brands because Marlboro's Philip Morris, but if you go and ask for I don't know what the Philip Morris e-cig is, but I know what Marlboro is. I don't understand why you can't go and ask for an e-Marlboro. I think they would do a lot better in that position. But if you're asking for a Blue or a Views or an Elf Bar or whatever else, I don't know if it helps them to the same degree. Whereas if you compare it to like going and asking for a Marlboro or a Camels, the brands just do have so much more power. So, but I think it will make some difference. I think at the smaller end, you'll get a lot of the smaller ones squeezed out. But for example, with like Elf, I think in the UK with the Elf bars, I think it's got to a position where whatever happens with the advertising, it probably has a fairly loyal base of customers that will stay with it. What do you think?
Suppose I think Philip Morris owned or bought Juul a few years when Juul was the big e-cig brand, particularly in the States. And then Juul was all about those fruity flavors. When they had more restrictions in the States, that really hit Juul. And it was a group or a company that Philip Morris had paid an awful lot for. So I think that's, it's interesting how some of these things can work.
Yeah. Right. Should we move on to spoons?
Yes. The booze.
Yeah. From the bags to the booze. It's
the
a sin stock special.
Yeah.
So, D Wetherspoons, they have come out with their full year results, and full year revenue was 1.9 billion with like-for-like sales growth of 12.7%. There was positive performance across all product categories. In the first 9 weeks of the current financial year, like-for-like sales growth slowed to 9.9%. That's still pretty decent, though. Underlying operating profit increased 92.4% to 106 million. That's a margin uplift from 1.5 to 5.6%, although still short of the 7.2% seen before the pandemic hit, but it's clearly moving in the right direction. Free cash flow was up from 22 to 271 million, including proceeds of about 169 million from the sale of financial instruments. This was the main driver of a 250 million reduction in underlying net debt to 642 million. That's very good. That's come down a chunk. No dividend was declared. They are planning to shrink the size of their estate by 26 pubs, and they're currently at 826, so bring them down to 800. But they're looking to do this to increase the average size and the distance between the pubs, which should increase average footfall and profitability. Prices were up about 4% last year, and they're hoping to keep the price rises below inflation. So I think that's really good, actually. Considering they only put the prices at 4%, I think that's very good. And then in terms of valuation, forward P of 16.6, 10-year average of 20, not currently paying a dividend. I think they've had a really good year. They've only put the prices at 4%, but they've grown 12.7. They're carrying on that growth. They are at sort of the more value-orientated end. So maybe in sort of a cost of living crisis, people have moved down to spoons from maybe some of the pubs which they would have otherwise gone to for a meal. But I think these are a very good set of results. The debt reduction is very good. Yeah, I think these are really good. But even if they got back to the 7.2% margins, operating profit margins from before the pandemic, I'm not sure I'd want to buy this business at 17 times earnings. I don't see where the actual growth is. I guess there's some growth in just getting back to where they were, but even if that brings it down to sort of 13, 12 times earnings, I don't know if it's a business I'd want to own. It's definitely not an industry I'd want to own. So yeah, it's not really much more to say. I think they've had a really good year, but just not an attractive stock, mainly because of the industry. John, what are your thoughts?
Same. I think just the industry as a whole would put me off, but Tim Martin does a very good job at running Wetherspoons efficiently and doing the best you can in essentially a bad industry. It's not that far off Greggs, and if you were asking me between Greggs and Spoons, I'd definitely go for Greggs.
Right, should we move on to something a bit more depressing?
Yeah, so Boohoo, the online fast fashion retailer, a stock that both Sam and I own, had their half-year results out last week, with half-year revenue declining by 18% to £729.1 million, ignoring the effect of exchange rates. UK and US revenue declined 19% and 12% respectively, and the active customer numbers were down 12% to 17 million. Underlying operating profit fell from £9.6 million to a loss of £3.9 million, impacted by the fall in sales and margins thinning. Net debt increased from £10.4 million to £35 million, and free cash flow fell from £20 million or £20.6 million to £2.8 million, in part due to the higher losses. Given the slower volume recovery than the group had been expecting, it meant that full-year guidance has now been downgraded. Revenue is expected to decline between 12 and 17%, compared with a 0 to 5% decline that they previously predicted. Underlying cash profit EBITDA is now expected to land between 58 and 70 million pounds, down from the 69 to 78 million pounds. The shares were down around 10% following the results. In terms of valuation, the group has a market cap of 400 million pounds and trades at 0.22 forward price to sales ratio, compared with a 10-year average of 2.1, and doesn't pay a dividend. As a shareholder, I was very disappointed with the results. They were worse than ASOS that we covered last time. Double-digit decline in terms of revenue in all regions, including 12% in the US, in which you're supposed to have the growth story and the investment case for Boohoo rather, and the customer numbers declining further. It's all, red flags all over the place. They've invested a lot in the warehouses abroad, particularly in the States, which is going to be a real problem unless the sales and growth picks up again. And the big question is, can it return to growth? Obviously, when we bought shares 2 years ago, we thought it very much could return to growth. And whilst the valuation had come down a lot, and I think it was around 17 times PE when we bought it, I mean, now as we've seen, it's continued to decline. It doesn't have earnings anymore. And I am beginning to question that. I think the share price decline since we bought it must be 80, 90%, something pretty huge. I'm not convinced anymore. I haven't sold my shares. I'm just sort of holding them tight, but I'm not that optimistic. And it does raise the question whether you just crystallize the loss and move on, or you just, I suppose, wait and see. I think psychology comes into it a lot, and that's probably more why I'm continuing to hold, rather than thinking that the fundamentals are necessarily going to improve. Of course, I hope they do, but I'm by no means convinced by it. And there's a lot of cost saving that management are doing, but unless they can really get that growth back, it's not hugely relevant, I suppose. Sam, any more optimism about Boohoo?
Painted a pretty bleak picture there. Yeah, it's a really difficult one. The results are really poor, like you say, a couple of years ago. I mean, one thing that's quite frustrating, I mean, is management don't know how things are going to play out, but they do have access to more information than us. So when we were starting to see these poor results coming through and they were continuing to ramp up the spend in the US, we were sort of saying, well, management obviously think this is just temporary, but then the US numbers are declining. So if they've got that wrong, it's a massive, massive error. Doesn't mean they were necessarily wrong to try, but I don't know. I mean, at the minute, they've still got free cash flow. So you're not in a situation, I don't think yet, where you're looking at this and thinking this could go bust. They've got the cost savings, but obviously the best way to increase your results is to do it on the revenue end rather than the cost end. If the revenue decline does start to stop, though, and they come out of this a much leaner business than they went in, I don't think it's necessarily a terrible thing. I think it is so cheap that you would get a very, very sharp appreciation in the share price. I think part of the reason it's so cheap, though, is it tells you what the market thinks about what's likely to happen. Now, we originally bought, I think was it like 90p or was it £1? It was about £1.20, I think. So it's down just under 30p now. So we're down about 75% on the original stake. I think I topped up at one point as well. So I think I'm down about sort of 70% overall. I won't be buying again. We've covered a couple of businesses in the last few weeks of mine where they're down, but the results are pretty good. So it's the conversation has been, well, do you add to it again? I've already added 2 or 3 times, but this is a very clear example of the kind of business you don't add to again. Because although you might get a sharp share price appreciation, if it starts to reverse these results, you can buy all the way down to 0. You can still have 100% drop from here. I'm probably not going to sell just yet because the cash position's okay. But I don't see a scenario where I'm still holding in 12, 18 months if they haven't turned this around. Because if you get to the point, I mean, what's not great is the debt starting to creep up now. Because this was basically a debt-free business when we bought it.
Yeah.
And I don't want to be in a position. I mean, I'd rather get 5% out than 0. I know it's a depressing thought, but if it gets to the point where you're looking and thinking this might be going bust in the next couple of years, I think you just need to pull the money out, however much it's down. I don't think we're quite there yet, but I will not be adding any more, and I certainly wouldn't recommend anyone else buy it. But I do like to give businesses. I mean, I've had a few people tweet me recently because like I've been chatting about some of my own businesses that I own. For example, like Hargreaves Lansdown. I'm like, well, you don't really like these businesses. Why don't you just sell them? Why are you like just holding on to like a stock that's at a loss that you don't even like? And I think the reason is because I don't want to build what I'd consider to be a bad habit. I'd rather have a few that I lose more on than I otherwise would than a few that I sell too early. Because I think you find your sentiment changes with the price as well. But I'd rather sort of lose a little bit extra on this than build what I'd consider to be a bad habit. Now, if this were to start turning it around, well, this is partly why as well. I think it's so cheap that if it were to start turning it around, you would get a very sharp share price appreciation. And I think you'd get the chance to recover a much higher amount of your money. I don't know if I'll ever get all my money back now, but I think selling now is probably the wrong decision, although I certainly wouldn't buy it.
Yeah.
Where are you with it?
I'd say similar. And I think it's very easy to get into that bad habit. I did own Centrica, and I have actually now sold Centrica. But I remember when we discussed it on the podcast, and it wasn't, Centrica, not a business that was in great health previously, lots of debt, lots of legacy problems. One of those national, an industry that had been nationalized, then privatized, and loads of bloat in it. And we covered it during during post-pandemic, and it looked terrible. I'd bought it, I think, about just under £2 a share, average something like that. And where the oil and gas prices were, you couldn't see much of a future for that business. It had a decent amount of debt and pension problems, all sorts of issues. And even though you couldn't see the future then, I didn't want to get into that bad habit. There was the psychological element, and then held it until about a month ago when it was turned out, the oil prices much, much higher. All of that money had come through. I didn't like holding it longer term because there's, a lot of governmental interference with it. But the share price must have risen about 3 times at least over that time, and then sold it. So you don't know what's going to happen, and fortunes can change around. And like you say, I think avoiding the bad habits creeping in is better for your long-term investing.
The good news is a stock you can't lose more than 100% of a stock.
Yeah.
Unless you buy it on margin, which we don't. But you can never lose more than 100%, but you can make a lot more than 100%. So I think if you're willing to sit on your hands and ride out some really bad losers. You are building that habit where you've got the businesses that are like, I mean, as an example, like my best performing stock's Mercado Libre. That's down about 40% from its peak in COVID, but I'm still up over 400% on it. Because I mean, and I expect after I bought it, there must have been a period where I was down. I don't remember anymore, but that habit of being able to just sit on your hands and not worry about it, I think you get the benefits on the bigger winners on the other side. Should we move on to a much better business?
Yes, so probably the highest quality business, I wouldn't say in the world, but certainly of the lineup this week.
Yeah, I'd say it's got to be up there as well. There can't be many better.
You could make an argument for it.
I think you could, yeah. So Nike, they have come out with their first quarter results, and revenues increased 2% on a reported and currency neutral basis to $12.9 billion. And all these figures are in dollars compared to the prior year. Revenues for the Nike brand were $12.4 billion, up 3% on a reported and currency neutral basis, led by currency neutral growth in Europe, Middle East and Africa, Greater China, and Asia Pacific and Latin America, partially offset by a decline in North America. Revenues for Converse were $588 million, down 9% on a reported and currency neutral basis, due to a decline in North America, partially offset by growth in Asia. Gross margin decreased 10 basis points to 44.2%, primarily driven by higher product costs and unfavorable changes in net foreign currency exchange rates, largely offset by strategic pricing actions. Selling and administrative expenses increased 5% to $4.1 billion. Demand creation expense, otherwise known as marketing and advertising, was $1.1 billion, up 13%. Operating overhead expense increased 2% to $3 billion, primarily due to wage-related expenses and Nike direct variable costs, partially offset by lower technology spend. Net income was $1.5 billion, down 1%, and diluted earnings per share were 94 cents, increasing 1%. Inventories were $8.7 billion, down 10% compared to the prior year, and cash equivalents were $8.8 billion, down approximately $3.1 billion from last year, as cash generated from operations was more than offset by share repurchases, cash dividends, and capital expenditures. And the Nike Direct's revenues were $5.4 billion, up 6% compared to the prior year on a reported and currency neutral basis, with growth across all geographies. In terms of the valuation, the business has a market cap of $152 billion. So it's actually come down quite a bit. It's down about maybe 20-25% from probably the last time we covered it, or from the start of the year. So it's now at a PE of 30.84. So I think last time we covered it, the PE was closer to 40. I think these results, they're a decent set of results. I just think this is one of the best businesses in the world. It is a brand I would love to have in my portfolio. But with the kind of figures it's putting up, it's pretty saturated. You can probably walk down most high streets, probably in the world, and you will see someone with the Nike tick. I think the direct-to-consumer revenue is a big opportunity, but I would like to see that growing at more than 6%, and I think it should be, really. I thought these results were all right. I would like to see direct-to-consumer increasing, but these aren't the kind of results you pay 30 times earnings for, or 31 times earnings for. So although it's a business I would love to own, it is just nowhere near the price at which I would consider it. It would probably need to be cut in half. Maybe there'd be a bit of a premium for the quality of the brand, but I don't think I'd want to go above 20 times earnings for it. And even that's probably quite pricey for the current figures it's putting up. So I know it's down sort of 20-25%, but I think it could still have a long way to drop because it is just incredibly expensive. But it's a fantastic brand. And at the right price, I would love to own it, but it's not at that price or anywhere near it at the minute. John, what are your thoughts?
Yeah, the results weren't as good as you come to expect sometimes from businesses as high quality as Nike. But as you point out, it's one of the strongest brands around, and direct consumer in the future, you'd hope that growth does increase at a faster rate than that. But I think the trend is overall positive. They can't do anything about the valuation, but with a business like this, when it's at such a premium for modest results like this, it's difficult to buy shares, I think. Is it a business that you'd like to own? Yes, but not at any price.
So of the 6 businesses we've covered this week, Tesco, Greggs, Imperial Brands, Spoons, Boohoo, Nike. Which one do you like the most? Which one do you like the least?
I'd probably go for Tesco's that I like the most. It's difficult because Nike, I think Nike I do like the most. If I were to own any, but just if we take valuation, into consideration here, I would go for Tesco's. Like the least, it's probably going to be Boohoo. Sadly, sad to say it.
I think for me, I would agree that in terms of obviously the best business is clearly Nike, but in terms of which one I'd like the most based on current valuations, it would probably be Imperial Brands.
Okay.
But that's just because, but even Imperial Brands, it wouldn't even be my first choice tobacco business.
Yeah.
But it's just so cheap that it's if I had to have one in my portfolio for the next 5 years, it's probably the one I'd be picking. But that's just pure valuation.
Pure valuation, yeah.
Like the least, it is probably Boohoo, unfortunately. Maybe that tells us something. But I'll continue to stick my head in the sand for a little bit longer.
Yeah. Put all of those Boohoo, news notifications on mute. Don't look at the results and don't look at your portfolio.
Yeah. Good advice.
Okay.
There's no problem that can't be solved by ignoring it.
Ignore it. Particularly, a problem like Boohoo. Okay, well, thank you again for listening, and we'll see you again next time.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.